I'm Sarah Borkson-Keeter with NAREITsREIT.com and welcome to Fundamentally Speaking. I'm joined today by Calvin Schnure, NAREIT's Senior Vice President for Research and Economic Analysis. Calvin, if you could start by describing the outlook for real estate fundamentals at the moment.
The economy is continuing along pretty much a similar trend to what it had last year. It's got moderate amount of momentum for it, but it's not really running hot. Now, what we have seen over the past couple of months is the Trump trade. The Trump rally, the stock market has been up quite a bit, and that has many people thinking that is this a signal that the economy has been stronger? And we've seen certain sentiment indicators that are stronger, but the solid economic data really haven't showed much increase at all. Auto sales came out recently and they were actually fairly weak, and consumer spending has been a bit sluggish. So we're not seeing any major increase. We're still seeing good momentum in the economy, but not any surge.
And the Federal Reserve has resumed its interest rate increases and has indicated that it will do so again. What's the outlook for REITs and real estate because of that?
Well, the rate increases really shouldn't change the trajectory for the real estate economy very much, for a couple of reasons. One is there's not a whole lot of leverage in the market. This has not been a lot of borrowing. The banks are lending, but the CMBS market has been really just refinancing the bonds that have been out there. So as a result, total commercial mortgage debt has only been growing about 5% a year. So it's really not been a situation where you've been levered up, which is what gets you into trouble a lot of times in the markets. The REITs have been particularly solid there. REITs have overall balance sheets with leverage that's lowest in about 2 decades. REITs raised about $200 billion in the past several years to support their purchases. So they've actually reduced their leverage, so they're in a quite solid position. There's a second reason why I wouldn't expect the rate outlook to change the picture a whole lot, and that's that rates are still very, very low. Rates are just historically very low, and the increases that the Federal Reserve is discussing are very modest. We're not seeing a spike in interest rates, so the commercial real estate economy, and REITs in particular, should do just fine with this interest rate outlook.
And in its discussions on economic conditions, the Fed has mentioned the commercial real estate sector. What sorts of concerns could they be having?
That's right. The Fed has raised questions about commercial real estate a number of times. Eric Rosengren at the Boston Fed has asked questions, and Fed Chairman Yellen has also asked questions. And they're looking at the increase in prices over the past several years and asking, is this a market that has gotten ahead of itself? Does it pose risks? Now, a couple things to keep in mind. One, the commercial property prices have slowed down. The past couple of months, there's been little or no change, and prices are up in the mid-single digits, 4 or 5% over a year ago. More importantly, though, the cap rates, although they're very low, it's in the context of low yields all around. Treasury yields are still very low, even with the recent increase. So that means that the spread between the cap rates and the Treasury yields is not tight. When that's a tight spread, that's an indication that pricing is very rich. There's still room in that cap rate spread to Treasuries for further rise in increases. But ultimately, it's the fundamentals that are going to keep this market on a solid keel. We do see occupancy rates at REIT-owned properties at a record high. Net absorption continues to outpace supply, and that's partly because the construction pipeline is still fairly moderate. It's not a huge wave of construction. So overall, commercial property sector is well positioned to go through this year and next.
Great. Well, thanks very much, Calvin.
My pleasure.
And for more news and analysis on all things REIT, be sure to visit REIT.com.